which company to select for investing. For that, you need to answer another important question. What is book value and market value? Because friends, you invest at the market price. If you take a decision to invest in Reliance today, the price at which it is trading is the price at which you will be buying one share of Reliance. So market price is given at any particular date. So what is it that you as an investor need to find out? That is called as book value, right? Or the intrinsic value. Intrinsic value of a company or the real worth of a company, real value of a company is what you need to find out. Compare that intrinsic value to the price at which Reliance is trading today and take your decisions further. So how are you going to take a decision further? We'll come to that a little later. But before that, let's understand what is the idea behind intrinsic value or the real worth of a company. Now, when I say this company is worth how much? What is the real worth of this company? Okay, it must be trading today at 2,000 per share, but what is the actual value of this company? So when it comes to value, there are two important elements to value that I would like to emphasize here is earning per share and book value per share, EPS or book value per share. These are two important proxy that you use to comment upon the intrinsic value of a company. So when I have to understand what is the real worth of a company, I can either say it in terms of EPS or I can say it in terms of book value per share. So how do you get EPS and book value, right? Where do you find EPS and where do you find book value to start with? So EPS is an outcome of whatever is happening in the income statement. Income statement, that means there are two important, although there are three important statements, not income statement, that a company makes and furnishes with the income tax department. But to now understand, as of now, there is an income statement which records incomes and expenses at one place to arrive at profit or loss at the end of that particular period. So if this income statement is made on a 3-monthly period, you will have profit or loss at the end of 3 months. Then there is another income statement which records incomes and expenses for next 3 months, and the outcome will be profit or loss for next 3 months, and so on. So for now, as of now, the companies that are listed are required to maintain their income statements after every 3 months. So there are quarterly income statements. So we can say that in 1 year, there would be 4 different income statements, and every time there would either be profit or loss, and so on. So income statement ultimately gives you profit or loss, which you use to calculate earning per share. How earning per share is calculated, how it all goes into the detailed calculation of EPS, I'm going to show you in another video, the link of which is there in the description box for you to understand exactly how earning per share is calculated and what sense does that make. But since the purpose of this video is limited to using these values for comparing it with the market value, I'm restricting my discussion on how to calculate EPS. But fairly we understand that income statement gives us earning per share. So where is the next matrix? The next matrix is the book value per share. So the book value is arrived at by doing some calculations in balance sheet. So what is balance sheet? Balance sheet is simply a place where a company would record the value of liabilities and the value of assets on a particular date. Okay, so balance sheet records the properties and the money that a company is supposed to pay to the outsiders at one place and gives us the financial strength of a company as expressed by the assets and liabilities. So with the help of those asset and liability numbers, an investor finds out book value and book value per share. Now that we have these two important metrics, which is earning per share and book value per share, these two can be used to compare with the market value per share to understand a very important and critical question, and that is whether the stock is overvalued or undervalued, right? If a stock is overvalued, how do you get to know that this stock is overvalued? Overvalued means the price at which it is trading is much higher than the price at which it is in the books. So if, let's say, for example, earning per share is 100 and the price at which it is trading is 200, we will say that it is overvalued because it is available at 2 times the price that it is showing, or the real worth of the company is only 100 per share and the price at which it is trading is 200 per share. So this is the reason why we use these metrics for making a comparison to take investment decisions. As an investor, think about it, whether you would be investing in a company which is available at 200 rupees, although the real worth of this company is 100 only. Any seasoned investor would not do that. A seasoned investor is always looking for companies which are available cheap. And availability is in the stock markets. So when the price, which is 200, right, and the company is worth 500, as expressed by EPS, that could be a better and a right choice for an investor. So investor generally invests in the companies which are available at their relatively lower price. Undervalued company. This is where the investments are done. So finding out of 2000 companies which are listed in Nifty, those companies which are available at a relatively cheaper price as expressed by EPS or book value per share is where the entire fundamental analysis discussion centers around. I hope, friends, you have understood what I wanted to convey here in this video. For more such important content, please subscribe to my channel and watch out some more interesting issues and things around fundamental analysis. So keep watching.